Hello, everyone. Welcome to Unit 4, Management Operations. Fair warning, it is a little bit of a long chapter, so feel free to pause and take the information in as you need it. And also feel free that you can speed up these movies if I'm a little bit on the slower side for you. So feel free to adjust however you need. All right, let's jump right in. When you have completed this unit, you will be able to accomplish the following. You will be able to describe the elements needed for staffing requirements and establishing a management office. You'll be able to explain factors necessary to determine management fees, summarize this information required to complete financial reports, including appropriate software, and identify information needed for reports for tax purposes and operating reports. All right, let's jump right in.
Overview. The management office reflects the scope and nature of management operations and is staffed by individuals who see that the company meets its commitments to owners and tenants. This responsibility includes maintaining records and producing reports that provide overall information that guides both the management company and its client owners in making business decisions. The location and layout of the office is determined by the nature and duties of the manager and the management company and may be on site or located a distance from the managed properties. In smaller companies, several people often assume multiple responsibilities. In larger firms, a clear hierarchy can be found. The management company must track its time and energy to competitively determine management fees by properly allocating direct and indirect costs related to each property it manages. Fees may be a per unit cost, a percentage rate, or a fee derived from the management pricing worksheet. Good record keeping is essential to providing for the easy collection, retention, and retrieval of records. Business decisions for a property will be based on the information in the reports. Performance reports on the property's operations gauge the profitability of an owner's investment. The reports provide the owner with a clear picture of how the property was managed during the past year, what should be done differently, what can be expected for the upcoming year, whether the property is worth keeping, and how successful the manager has been. The law requires that certain tax-related forms and reports be prepared and filed with local, state, and federal government departments. Operating license fees, inspection fees, and other fees also must be paid. Many of these records are maintained electronically, and as previously mentioned, the proper software program is a major decision affecting operations for some time. All electronic records must be protected from loss, so it is critical that backups and duplicates are stored off-site. Establishing and staffing the management office. Learning objective. Describe the necessary elements and staffing requirements for establishing a management office. Establishing the management office location and layout. The location, organization, equipment, and staff of the management command post varies with the scope of the operation. Initially, the office may consist of only a property manager and a secretary. The most logical site for the manager S office is on the premises if most of the management operations are conducted there. Even if a manager has a home office elsewhere, a small office is often set up on the property for specific functions. The office should not occupy space that has a specialized high rental value, such as the ground floor of an office building. Management firms and large real estate agencies in metropolitan areas often have main offices in prestigious high-rise quarters in the center of the business district. As business expands, they then establish smaller ground-level offices in outlying neighborhoods or in managed properties. Office design. Furnishings should be affordable, attractive, tasteful, uniform in style, and well arranged. The office should be designed to accommodate several different areas for specific uses, including the following: an attractive reception area available for prospective clients and service personnel, space for comfortable private interviews with clients, potential employees, and business people, an accessible and private place for tenants to pay their rent, make service requests, or negotiate lease renewals, office space for administrative functions such as timekeeping, payroll, purchasing, billing, accounts receivable, bookkeeping, collections, and preparation of government reports. An area large enough to prepare and store records for the properties. Files. The mark of an efficient management office is a good filing system. Data should be sorted and segregated into separate files for easy collection, retention, and retrieval of records. Even though much of the working information is stored electronically, certain paper documents will still have to be maintained. These paper files should be reviewed periodically, and outdated material should either be shredded or moved to a storage center off-site. The boxes containing the files should be clearly labeled in the event that anything must be retrieved. Files. Whatever the size of the office and the method of filing, the records can be divided into 5 general filing categories. Lease files, general correspondence files, work estimates files, financial files, permanent files, leases. The lease file should contain current lease instruments, as well as tenant credit and reference data. Leases usually are filed first by building and then by unit number. With a manual system, the manager can utilize a lease expiration list or tickler file of lease expiration dates to track leases coming up for renewal. Alternatively, lease expiration dates can be included in electronic tracking programs. Expired leases should be moved to a separate system and filed alphabetically by tenant name. These paper records may be stored off-site and then discarded after an appropriate time, such as 10 years after the tenant vacates the property. Documents containing personal information about the tenant must be shredded to maintain privacy. Correspondence. A general correspondence file should contain all communications with tenants. Correspondence usually is filed according to building, with each building then subdivided alphabetically according to tenant name. This file may be electronic or paper and should be updated annually. Typically, older documents may be discarded after 3 years. However, managers should check on their state laws for guidance. For work order bids. When placing service contracts and contracting for new construction, the manager usually solicits work order bids from 2 or more contractors. These estimates should be filed according to the property involved. Even if the job is not placed with a particular bidder at the time of the solicitation, these bids can provide important comparison data when considering future projects. New files should be set up yearly because cost estimates do not remain current. Financial files. Check registers, canceled checks, receipts, and disbursement records are usually retained for a 10-year period in a financial file organized by building. The file also organizes budgets, monthly income and expense reports, yearly profit and loss statements, and other financial records for each building and its employees. These basic documents should be retained for the duration of the management operation. Files generated electronically should be backed up at least weekly, if not daily. The backup should be stored in a fireproof safe or off-site. Permanent files. These files are rarely referenced, but they need to be easily identifiable in the event of an emergency. A permanent file holds the management contract, mortgage and title information, labor contracts, a legal description of the property, and similar documents. Insurance policies on the property may be kept in this file, but it is preferable to have them in a separate folder with the coverage terms, policy limits, and expiration dates clearly visible on the outside for quick reference. A separate tickler list of policy expiration dates should be posted in the permanent file so that new entries can be made immediately and expiration dates monitored regularly. Expired insurance policies should be kept for 5 full years. Staffing the management office. The most basic qualification for an employee in the field of property management is versatility, because few management organizations are large enough to support a staff of specialists. The property manager and a secretary bookkeeper may be the only staff during the early stages of a business, but larger established management firms or departments often employ several people in each of the positions described in the following sections. The most important point is that all of the functions must be completed, whether by 2 people or 20. Property management executive. Because the chief property manager or property management executive often determines the success or failure of the operations, this person must be knowledgeable and experienced to control both the strategic and the operational aspects of property management. During the growth years, the responsibilities can be classified as executive or administrative. The executive function includes preparing budgets, developing an advertising program, leasing, inspecting properties, communicating with tenants, contacting owners, contracting for services, hiring, training, and supervising both office and on-site employees, directing major repairs, and supervising all administrative functions. As part of the administrative function, the property management executive oversees collections, disbursements, payroll preparation, and recording, submits monthly operating reports, and keeps records in all areas. As soon as the organization is large enough to make it economically feasible, the management executive should hire and train subordinates to assist with the work. Eventually, the property manager executive will supervise others in order to devote full attention to setting the general policy for the organization, developing new business, supervising operational costs and activities, and building employee morale and motivation. On-site manager and building personnel. A carefully selected and qualified on-site manager is often authorized to hire custodians, handymen, and other maintenance workers, but the property supervisor will want to retain the right to approve the on-site manager's employment decisions. Often, a leasing agent who has shown initiative and promise is promoted to either an assistant on-site manager or to the manager position. Purchasing agent. The purchasing agent is responsible for all purchases made by or through the management organization. Only large organizations can justify a full-time position for this function. In smaller management offices, the property supervisor or an accountant usually performs the job of the purchasing agent by compiling a list of preferred suppliers, contractors, products, and equipment, and making purchases. Office manager controller. The office manager or controller interprets the income and expense reports, makes major decisions regarding new procedures, and submits profit and loss statements to the owner. A single controller is usually responsible for all of the properties managed by the firm. Because this is a crucial function, the executive property manager in a smaller operation will usually assume responsibility for it. Cashier bookkeeper. Bookkeepers spend most of their time preparing rental bills, receiving and recording rent payments, keeping an account of monthly income and expenses for each property, and handling accounts payable and receivable. Regardless of the competence of the bookkeeping staff, it is wise for a management office to have an outside accounting firm audit its books semi-annually or annually. Bookkeepers also handle the payroll and maintain operating cost records for the management firm's operating costs. Depending on the owner's demand for detail and the type of accounting system in use, manual or computer, a single bookkeeper can usually handle 8 to 10 properties. This person may be able to handle more properties in a large management firm because the assumption of more properties justifies a more sophisticated accounting system, which requires less time and labor per property. Clerical personnel. Clerical personnel can be divided into two major groups: secretaries or administrative assistants and service request clerks. Secretaries are responsible for answering telephones, maintaining contact between the field managers and the central office, and handling the general correspondence of the management organization. General reception for the main office can be performed by these employees or by special receptionists. Service request clerks accept phone calls from tenants, easing the burden on the secretarial staff. These clerks provide a team of persons ready to respond prompt and patient to tenant requests and can also act as liaisons between the main office and the building. They can notify the custodian of a service request, write the purchase order for items needed by the on-site staff and have it approved by upper management, then route the requisition material to the appropriate building when it arrives. Branch offices. As the management organization grows, branch offices may be opened in outlying areas to handle newly acquired business more efficiently. Traditionally, each outlying office is run by a property manager and a salesperson in charge of new accounts, assisted by a receptionist, bookkeeper, secretary, and possibly 2 accounting clerks, one for accounts receivable and another for accounts payable. Isolated apartment properties should have a manager's representative on site, if only part-time. To avoid the problems of complete centralization, management functions integrally related to the neighborhood can be performed at branch offices, leaving the main office to take care of more standardized activities. Centralized accounting systems require only a property manager, a secretary receptionist, and a salesperson who solicits local accounts at each branch. This arrangement can reduce the staffing needs of a branch office by 40% or more, actually increasing the overall efficiency and profit margin of the management company. Key policy. Accuracy and uniformity of reports and records is a byproduct of centralization. Perhaps the greatest benefit, however, is that new properties can be acquired and managed with fewer additional staff to the branch office and with minimum additions at the main office. Licensing. The management company should determine which licenses it is required to obtain. Local ordinances may require that the company obtain a business license to operate. High state real estate regulatory agency may require that individuals performing certain activities, such as negotiating leases or collecting rents, hold either a property management license or a real estate license. In such circumstances, the ability to obtain a license could be a requirement when hiring certain personnel. Mergers. In today's economic climate, many property managers are joining forces with other real estate professionals to increase their competitiveness. For example, property management firms may merge with real estate brokerages or auction firms. Policy and procedures. A property management policy and procedures manual is a living document that defines company philosophy, mission, office organization, and operations. The manual also dives into the broad scope of professionally managing property and working with investors. There is no one standard policy and procedures manual, so property management firms must create their own that is unique and relevant to their specific company. A well-written and effective policy and procedures manual is critical, as without a manual, those involved with the company lack an overview of the business, sound training, and a resource for answers when crises arise. Without the manual, retaining clients and employees becomes much harder. A policy and procedures manual should be made for the firm in order to accomplish, for example, risk protection by way of compliance, reduced redundancies, through job standardization, adherence to best practices that maintain the highest ethical standards, improved operational excellence leading to the company's recognition in the market, and enhanced performance leading to client and key stakeholder confidence. Not only are these manuals often helpful for the success of the company, but they may be legally required depending on the state. Even in states that do not require policy and procedures manuals, when lawsuits arise, these manuals are often relevant and requested by legal entities. When there is a lack of documentation, policies, procedures, and systems, such as those found in a company's policy and procedures manual, a company is at an extremely high risk for legal issues. If the manual includes guidelines for how the company screens and approves tenants, for example, fair housing lawsuits will not arise, as the manual proves that the company is not discriminating against people. You will typically get a discount on EO insurance if you have a manual already also. Examples of what may be included within the policy and procedures manual include the following: office policies such as dress code, lunch breaks, office hours, parking information, etc., relevant forms, laws and regulations, compensation commission information, etc., agency, disclosures, escrow, evictions, marketing, leasing application process, leasing policies and procedures for the HOA, tenant policies, smoke and carbon monoxide detectors, property inspections, property maintenance, early termination by military personnel. Although creating a policy and procedures manual may seem time-consuming, and some may feel they can deal with issues as they arise, it is better in the long run to have a manual in place so that there is regulation and consistency in the resolution of issues. Determining budgets and management fees. Learning objective. Explain factors necessary to determine management fees. When setting management fees, the pertinent variables must be evaluated and assigned in order of importance. Business will be lost if the estimated percentage rate is too high and is not competitive with the market rate. On the other hand, cutting back on necessary management services and staff to lower management operational expense or accepting management contracts that will not cover costs will only deteriorate the management organization's reputation, impair its financial structure, and hurt its business. A sound policy is to review all management contracts annually and raise fees on properties that are causing problems or consuming an inordinate amount of time without generating sufficient monetary compensation. Before any management fees can be set, the management executive must first know how much it costs the organization to provide its management services. A budget that includes the direct and indirect costs of operation will show the total cost of doing business. Each management firm has the right to set its fees according to its needs. However, care should be taken so that setting of fees does not even appear to be in collusion with other firms, which would be in violation of antitrust laws. Most management fees are related to the property's gross collected income. Fees may range from as little as 2% to as much as 20% of the gross collectible income from a property, depending on the management risk, the size of the building, and the profit margin. Because of the numerous variables involved, there is no universally valid formula for the computation of management fees. In the last analysis, the local market and negotiation between the owner and the manager set the fees. Residential property issues are quite different from those involved in managing industrial property. The size, condition, and location of the building, among other factors, also have an effect on the profitability rate for the management of the property. In general, however, there are several ways of computing management fees. One method bases the fee on the per unit cost of management, which is derived from the operating budget for the management organization. A second method employs a standardized management pricing worksheet. Direct costs. All costs incurred by an individual manager or management firm can be considered direct costs. If management operations are a division of a real estate agency, however, direct costs would include all expenses incurred during the performance of the management business that are not charged to or shared by another department of the parent company. General office expenses included in direct costs are the payroll for the management staff, depreciation on office furniture and equipment, equipment maintenance or rental, insurance premiums, legal, auditing, and other professional fee, stationery and postage, utilities, taxes, office supplies, and office rent. Business promotion and automobile expenses are also considered direct costs. Indirect costs. Indirect costs are incurred when a management department shares facilities and expenses with other divisions of the parent company or real estate agency. Although they may amount to 25% or more of the total cost of operating, they are less visible than direct costs and therefore are often ignored when drawing up a management department's budget. A proportionate share of occupancy costs, general office overhead, and accounting overhead should be assigned to the management department as its indirect costs. Per unit cost method. Essentially, the per unit cost is a total of the total management costs, both direct and indirect, for 1 year divided by the number of units that the firm is capable of managing plus a percentage for profit. It is important to use the number of units the firm is capable of managing as opposed to the number of units the firm is actually managing currently, or the per unit cost will be unrealistically high and not competitive. Although each management firm decides on its own profit margin, the typical range is 10 to 20%. For example, a management firm with total operating expenses of $100,000 and the capability to handle 1,000 units will have a yearly per unit cost of $100. Adding 20% for profit, the per unit fee is $120. This figure represents the minimum per unit fee that must be obtained regardless of the type or number of buildings or units being managed. Adjustments to per unit fee. No standard method of setting a fee can possibly make allowance for every contingency. Therefore, the per unit fee often has to be adjusted to reflect the economics of a particular situation. For example, one large building with 50 units may be cheaper to manage than 5 separate properties of 10 units each. The travel time involved in field supervision of separate buildings is much greater, as is the total number of personnel and separate operational systems that must be inspected. Any factor that adds to the time spent in caring for the premises should be reflected in the per unit fee. The following illustrates some of the times that the fee should be increased. For a small 10-unit property to compensate for the inefficiency of decentralization. For buildings with internal problems, a significant amount of deferred maintenance, or a pressing need for new construction or repairs. For an owner who wants to be informed of every detail of operation, and this category often includes government agencies taking more management time. For properties located in depressed areas because of vandalism and related social ills. Percentage rate. The percentage rate can be calculated by using the per unit fee, the total number of units in the building, and the gross income of the property. First, multiply the per unit fee as adjusted for the property by the total number of units to obtain the dollar amount of the management fee that must be recovered. Next, determine the gross collectible income for the property by subtracting a realistic vacancy and loss rate from the annual gross income. Finally, divide the dollar amount of the management fee by the gross collectible income. The resulting figure, when expressed as a percentage, is the base property management fee. Both owners and managers generally prefer a percentage fee to a flat rate because it gives the manager an incentive to increase the income of the property by raising rents and cutting operating costs, therefore maximizing the owner's profits. A flat fee may encourage a certain laxness in administrative and executive functions, especially rental on the part of management, because it is a constant that will change only through negotiation with the owner. For some properties, though, a flat fee might be more appropriate, particularly when managing condominium associations or cooperatives. The owner-occupants certainly want the manager to maintain or lower the monthly maintenance fees, but a percentage fee might encourage the manager to raise those fees. In another example, a manager might want to consider a flat fee agreement, at least initially to compensate for extra work and lower profit for properties with much deferred maintenance, excessively high tenant turnover, or an undesirable tenant population that will have to be evicted. Some management contracts provide for a management fee plus a separate fee for obtaining new rentals. This practice is prevalent when dealing with retail space. The disadvantage of this arrangement is that it may encourage the manager to allow or create a greater tenant turnover than is warranted. Many managers prefer to build the compensation for their leasing activities into the basic management fee by raising it slightly. Financial reports. Learning objective. Summarize the information required to complete financial reports, including appropriate software. Before preparing any financial reports, the manager must set up a method of accounting for funds received and disbursed, keeping in mind the needs of the owner. Laws in most states prescribe rules for handling trust and operating accounts of licensed brokers. An accounts receivable ledger is preferable because all cash receipts can be posted to the appropriate ledger card. Written orders should be issued for all purchases, and purchase orders should be matched to incoming invoices before payment is made. Key policy. Automating these functions can take the sting out of preparing reports. After entering data once, a fully integrated accounting system can dramatically reduce the manager's time spent on accounting functions by generating reports at the touch of a button. Some of the best programs permit separate accounts for each property and owner, set up on a cash or accrual basis, calendar or fiscal year. Budget comparison statement. The budget comparison for the property compares the actual results with the original budget drawn up either at the beginning of that period or at the time the manager assumed responsibility for the property. When maintained as an operating checklist with ratios from the current period checked faithfully against past performance, trends may be detected that call for the property manager's attention. Cash flow report. Income. The income portion includes gross rentals collected, delinquent rental payments, vending contracts, utilities, storage charges, and sale of extra services to tenants. Then, any losses incurred from evictions and from uncollected or delinquent rentals are deducted from the total gross revenue. The resulting figure is the total adjusted income from the property. As a control measure, some owners require a property manager to list separate categories of items that are not producing income, such as vacant rental units, support space, for example, the manager's office or residence and maintenance or storage areas, vacant space under major repair. All rental space in a project should be considered when computing the gross possible income. The rental value of each space not producing income is deducted from the gross possible rental income to equal the gross collectible or billable rental income. Expenses. Operating expenses may be direct or indirect expenses and fall into 4 general categories. Wages paid to building personnel. General operating expenses such as utilities. Maintenance expenses. Administrative costs. Direct expenses do not fluctuate with rental income and can be either regularly recurring costs or periodic costs. Regularly recurring costs arise each month. Examples include employee wages, basic operating costs, and maintenance expenditures. Periodic costs such as property taxes and insurance premiums recur at longer intervals. These costs are directly incurred by the building. Specialized maintenance services such as roof repair, utility charges, refunds, and capital expenditures are variable expenses and can be either recurring or non-recurring. Decorating costs, minor repairs or replacements, and replenishment of supplies will predictably occur at varying intervals during the year. Landscaping and snow removal are examples. Variable operating expenses, capital improvements, additions, or repair of fire damage may or may not occur in any given year. When both fixed and variable expenses are deducted from total income, the resulting figure is the month's net operating income before debt service. Net operating income minus mortgage payments and other fixed expense and deposits to reserve accounts equals the cash flow or net receipts remitted to the owner for that month. The monthly cash flow report can be summarized in the following formula. Gross rental income plus income from other sources minus losses incurred equals total income minus operating expenses equals net operating income before debt service net operating income before debt service minus reserves equals cash flow. Profit and loss statement. Owners expect a profit and loss statement monthly, quarterly, semi-annually, or annually. Monthly cash flow reports provide the raw data for these statements. Most such statements list gross receipts rather than itemized sources of income and the total of all operating expenses instead of individual expenditures. The entire amount paid for debt service mortgage payments cannot be considered an expense on the profit and loss statement as it is on the monthly reports. Only the interest portion of each mortgage payment is considered an expense. The equity portion of each mortgage payment is actually applied toward retiring the total debt, thereby increasing the owner's equity in the property and accruing to the owner's benefit. After the total mortgage payment has been deducted from the gross receipts, the mortgage loan principal must be added back in to obtain the net profit on the profit and loss statement. The general formula for preparing a profit and loss statement for any type of property is as follows. Profit gross receipts minus operating expenses minus total mortgage payment plus mortgage loan principal equals net profit. Operating budget. After developing the profit and loss statement for a specific period, the manager should compare the actual results with the original budget drawn up either at the beginning of that period or at the time the manager assumed responsibility for the property. After making the comparison, a new operating budget may be drawn up. The budget gives the owner an idea of the cash yield to expect from the property during a fixed period, traditionally a year. The budget serves the manager as a guide for future operation of the property and as a measure of past performance. If the projected budget for a period does not agree with the actual monthly income and expense reports and the profit and loss statement for the same period, appropriate adjustments should be made in subsequent operating budgets or in operating procedures. In fact, many managers divide their annual operating budget into 3-month segments so they can compare the budget with actual income and expenses on a quarterly basis. This helps pinpoint expense items that are out of line before a whole year has passed. Estimate conservatively. The manager should resist setting unreasonably high goals for leasing agents or site managers to reach. Unreachable goals are self-defeating if the organization morale suffers and competent personnel quietly seek other employment. Wise managers should set realistic goals that will allow the company to grow and prosper. When preparing a budget forecast, the manager should use present rental rates for the estimates, rather than anticipated increases in revenue. Then, if the profit and loss statement at the end of the period shows a greater revenue than originally indicated on the budget projection, the manager will be able to point out what contributed to the increase. Examine discrepancies and prepare explanations. Before forecasting expenses for the new budget term, the manager should examine all discrepancies between anticipated costs as projected in the budget for the preceding year and actual expenses incurred as shown on the income and expense reports from the same period. Substantial differences indicate either problem areas for management or items for which the projected estimates were unrealistic. If there is a decrease in the expected revenue, the manager should be prepared to explain why. Examine discrepancies and prepare explanations. After determining the reason for the difference in costs, the manager should adjust either the operating policy or the forecast for the new budget period. An accumulation of budgets and comparative summaries over an extended period provides a valuable synopsis of recent trends and alerts the manager to areas of unfavorable progress. The budget forecast should make allowances for vacancies and delinquent payments during the period to be covered. The cash flow reports for preceding months will tell the manager how much of an allowance to grant. The relationship between rentals billed and monies collected can be used to project an actual occupancy ratio for the property. Allow for an evaluation of management skills. The owner can use the budgets and reports to judge the manager's skill in recognizing financial and market patterns and in coping with problem areas. The books and records of the management firm should be audited at least annually. Not only is this proof of good faith, but many lenders and other parties require an audit before they will execute mortgages and other legal documents pertaining to properties under outside management. Equipment. Very few, if any, offices can run without the use of some equipment. Office equipment such as fax machines, copiers, postage scales, calculators, and computers are fundamental, not optional once the business begins to grow. All information about the machines, such as training manuals and maintenance contracts, should be located where the information can be easily accessed. The use of computers in small businesses has become commonplace in large part because the initial cost is so low and because software companies have developed such easy-to-use software. Managers and clients should recognize that using a computer does not make life any easier. Computers simply provide more information on which to base decisions, and not every company needs all of the reports that can be generated. Thus, the management company must look carefully at each segment of the organization to determine the information it requires and will actually use. Plus, once the company begins to depend on the information supplied by the software, it is essential that someone is responsible for backing up all of the information at least weekly, if not daily. Whatever memory storage method is used, see the following pages. These backups must be protected and should be stored off-site or in data storing virtual warehouses. Hardware. Key policy. Matthew Ferrara, a technology consultant, suggests taking the Goldilocks approach when buying any technology, including hardware, software, and phones. Remember Goldilocks in the Three Bears house? She tried things that were too small or too large, and then one that was just right. Some technology investments tools are too little, some technology investment tools are too big, some technology investments are just right. Any technology that has a significant price markdown should be suspect because the low price might indicate that it will soon be out of date or lacking enough features to have an adverse effect on productivity too small. Likewise, overkill investments do nothing to improve productivity as they have excess, unusable features incurred as an expense that cannot pay off, as Goldilocks could not eat the entire bowl of porridge even though it had more. In every technology, products exist that are just the right combination in terms of usefulness, features, and price. Software. Today, various software companies offer software specifically for the property management industry to help property managers run their offices more effectively and manage their properties more easily. A company that does not want to take a risk buying a software program only to see the program become outdated can work with web-based outsourcing companies. Web-based products are run on their servers, and the property manager client can access and use the products over the internet. With so many options, managers must do their homework before making the purchase. Several steps are involved. Ask other management companies what program they use. Do they recommend it? What don't they like? Attend a trade show and talk to various vendors. Ask for and try out a demonstration demo version of the software. Research the company to determine how helpful it will be if there are problems and try to determine how stable it is. Find out if the product is specific for property management or has been adapted from a general accounting package. See if it meets the manager's reporting needs. Determine if it is easy to learn. Basic software functions. Data sharing. At the very basic level, computer software uses two types of programs to make office lives easier. The first is word processing and the second is spreadsheets. A word processing program such as Microsoft Word allows the user to key and type a letter, insert or delete characters, words, lines, paragraphs, or even pages of text, and merge that text with a mail list to generate mass mailings. Programs also offer templates for late notices, eviction notices, lease termination, and letters on all types of problems, pets, excessive noise, garage usage, etc. These form letters can be customized to meet the company's specific needs. A spreadsheet program such as Microsoft Excel takes the entered data and performs mathematical calculations. It can use these numbers to tie information together to produce a financial report. With most programs, the user can expect to input data once, access that data at will, and easily move the data between a word processing document and a spreadsheet to make calculations and generate reports. For example, the tenant and lease information is keyed in at the beginning of the lease, identifying rental due dates. Later, if the tenant is late in paying the rent, the program will automatically generate the appropriate late notice letter, thus relieving the office person from having to remember. At the end of the month, all of this information will be tied together to produce the report indicating the percentage of late paying tenants. Financial record keeping. The accounting portion is a very sophisticated spreadsheet program. It should perform bookkeeping calculations automatically, including accounts receivable, accounts payable, payroll, inventory, and general ledger. Accounting programs can generate various reports that are valuable for financial planning and evaluations, including monthly budgets, cash flow studies, profit and loss statements, and reports to owners. Many even write and print a check, while entering that directly into the bank balance summary, thus maintaining even more up-to-the-minute control. Tracking maintenance. Many software packages can integrate maintenance items with the appropriate and necessary financial records. Data processing software programs allow property managers to enter requests for maintenance, due dates, vendors, bids, completion dates, and more. Internet. The Internet is a global system of interconnecting computer networks. The Internet has quickly become a vehicle for advertising, marketing, and communication. Savvy tenants use the Internet to locate communities before arriving in a new city. There are even mapping programs available that allow the user to merge a local map with information about properties and neighborhoods. Managers can very quickly do credit checks on prospective tenants and employees. Reports for tax purposes. Learning objective identify the information needed for reports for tax purposes and operating reports. The information given here is of a general nature because tax law is constantly changing. Property managers should obtain the latest IRS circulars and copies of state and local tax regulations and consult with competent tax counsel before filing any tax documents. Even if an accountant prepares the owner's federal and state income tax returns, the property manager should at least be familiar with the purpose of the various tax liabilities and tax records forms. Income and expense statement. The income and expense statement adjusts the total net operating income from the property to allow for depreciation of the premises during the year. In addition, any expenses, such as tenant alterations that are considered capital improvements, are removed from the expense classification and are added to the property's depreciation schedule. Depreciation accounts for the decline in value from physical deterioration, functional obsolescence, and economic obsolescence. For tax purposes, only depreciation from physical deterioration is deductible from the property's income. Note that depreciation only applies to the improvements or the buildings on the land. The land itself does not depreciate. The rate to be used depends on applicable tax law, which will vary according to the date the property was placed in service. The property manager must consult with a qualified tax advisor before preparing any tax return. The material presented in this book is for the purpose of illustration only. Pre-1981 properties. Property placed in service prior to 1981 may be utilizing several different recovery periods. Once the depreciation of a property has been calculated by a certain method, another method cannot be employed without authorization from the IRS. Formerly, there were 3 standard methods for computing the rate of physical deterioration. Straight line method, declining balance method, sum of the years, digits method. The straight line method of computing depreciation assumes that the deterioration proceeds at a stable rate over the useful life of the building. The yearly percentage of the building's cost that is lost through depreciation rate is found by dividing 100% by the years of useful life of the building. For example, if a property can be expected to be used for 50 years with normal maintenance, the straight minus line depreciation rate is 2%. Accelerated Cost Recovery System, a CRS, 1981. Congress established the Accelerated Cost Recovery System called ACRES from its acronym, a CRS for property placed in service in the year 1981. A CRS prescribes methods of recovery of expenditures through a depreciation allowance that varies according to the type of property being depreciated. Tables published by the IRS set forth the ACRS percentages by property type and for the period the property is held. Tie tables for real estate are applied on a monthly basis in the first year the property is placed in service and allow recovery over prescribed periods of years. Percentages for real estate, except low-income housing, and percentages applicable only to low-income housing are shown in 2 separate tables. Modified Accelerated Cost Recovery System, 1986. In 1986, a CRS was amended for property placed in service beginning in 1987 called MACRES from its acronym MACRS. Basically, 4 new classes of property were added, 2 of which were classes of real property. Both must be depreciated on a straight line method. Residential rental real estate was assigned 27.5 years of depreciable life, and non-residential real property was assigned 31.5 years. Prescribed methods of depreciation were assigned to each class of property rather than providing statutory tables, as was done in 1981. In some classes of property, a 200% declining balance method is prescribed, but the taxpayer is allowed to switch to the straight line method if it will yield a larger depreciation. For other classes, the declining balance is set at 150%. Revenue Reconciliation Act of 1993. For property placed in service on or after May 13th, 1993, the new provision increased the recovery period of non-residential property from 31.5 years to 39 years. Subsequent capital improvements to income-producing property may, with certain exceptions, be depreciated over the useful life of the improvements. Leasehold improvements are depreciated over the life of the lease unless the life of the property itself is extended by the improvements. In the case of extended life of the whole property, a longer schedule is required that reflects the true benefit of the improvements. Depreciation rules must be applied with care regarding subsequent capital improvements because certain improvements may not be depreciated. Landscaping of shopping centers is an example of an improvement that may not be depreciated. Under the same rule, however, shrubbery and trees planted on apartment building grounds may be depreciated. Investment tax credit. Section 42 of the Internal Revenue Code addresses these issues for residential and multifamily housing. Federal income tax credits are allowed for certain depreciable property investments, and regulations vary for energy, anti-pollution, employee stock ownership plans, and other categories of property investments. Both the 1986 tax revision and the 1993 tax revision provide for tax credits to owners of low-income housing. If an investment tax credit is claimed and the property is sold or disposed of before a certain period of time, the investment tax credit must be repaid to the IRS. Tax credits are available for qualified rehabilitated buildings and for the restoration of certified historic structures. Unlike depreciation, a tax credit is not an expense item for calculating taxable income, but rather a direct offset against tax liability. There is a dollar-for-dollar credit on new construction of multifamily housing. Properties are unit qualified using the median income for the entire area. This program has proven quite popular both with investors and tenant populations that qualify for and benefit from subsidized rents. As tax laws frequently change, property managers and property owners should constantly check with qualified accountants for the most recent versions. After-tax cash flow. The depreciation allowance is subtracted from the total net income from the property for the year. The resulting figure is the basis for the owner's tax liability on the profit from the property during that year. The actual tax due is taxable income times the appropriate percentage rate determined by the owner's tax bracket. Taxable income minus tax due minus the principal add back plus depreciation equals the after-tax cash return on the property. The calculation of any report for an owner must conform to the owner's wishes. The formats used in this text are presented as methods that have found general acceptance. Specialized situations will require adaptation. Statement of after-tax cash flow. Losses and credits from passive trade or business activities, to the extent they exceed income from all such passive activities generally, may not be deducted against other income, such as salaries and wages or interest and dividends. The one major exception is the ability of middle-income taxpayers to deduct up to $25,000 of rental losses from actively managed real estate. To qualify as materially participating, a person must devote more than 50% of personal services to real property trades or businesses during the tax year, or devote more than 750 hours of service to these activities and be involved on a regular, continuous basis. Qualifying activities include development, redevelopment, construction, reconstruction, acquisition, conversion, rental operation, management, leasing, or broker trade activities. Material participation is closely defined by the IRS, so again, anyone seeking this deduction should consult with an accountant. Revenue Reconciliation Act of 1993. Beginning January 1st, 1994. Rental real estate activities, REIS, in which the taxpayer materially participates are not subject to limitation under the passive loss rule if the taxpayer meets eligibility requirements relating to real property trades or businesses in which the taxpayer performs services. Real estate investors who qualify are now permitted to deduct their rental real estate losses from their current commissions, wages, interest, and dividends. Tax laws are complicated and constantly changing. A property manager should be aware of these basic rules, as there is still misunderstanding among some owners and many would-be investors seeking tax shelters. However, it is imperative that property managers consult qualified tax specialists to get the most current, accurate tax information. Tax records. Property owners who pay people to work for them may be considered employers for federal and state income tax purposes and may be required to file certain reports with the appropriate government agencies. Most states have precise specifications as to the minimum number of persons on the job, total amount of wages paid, and working conditions that must exist before an owner is classified as an employer. Employees and independent contractors. The difference between an employee and an independent contractor is also significant in terms of federal and state taxes. Workers are deemed employees if the person for whom they work has the right to direct and control when, where, and how the work is done and to define the desired end result of the work. Independent contractors are able to control when, where, and how they perform the work and are hired to produce an end result. An agreement between owner and independent contractor must include a clause providing for the right of termination by either party on notice to the other. This is just one of the many fine distinctions that must be considered when contracting for work and when deciding whether a worker is to be considered an employee or a special independent contractor for tax purposes. Managers must not attempt to disguise employees as independent contractors if a bona fide independent contractor relationship does not actually exist, because the penalties from tax and liability standpoints can be severe. Employee Documentation Employer Identification Number EIN. If the workers at a building are employees under the law, the owner or the property manager on the owner's behalf must obtain a federal employer identification number from the IRS. Employees Withholding Allowance Certificate W-4. All employees must have a Social Security number and must fill out Form W-4, Employees Withholding Allowance Certificate, stating the number of tax exemptions they intend to claim on their tax reports. The government charges the employer with the responsibility for obtaining these W-4 certificates and for complying with other important regulations concerning employees. Employment Eligibility Verification I-9. Upon being hired, all employees must complete Federal Form I-9 Employment Eligibility Verification to establish they are lawfully able to work in the United States. The employee must complete and sign one section attesting to citizenship. A non-citizen employee must furnish evidence of lawful admittance for permanent residence or employment authorization. The second part of the form requires the employer to review and verify the employee's statements using documents furnished by the employee. The form must be presented for inspection to officers of the Immigration and Naturalization Service or Department of Labor upon request. Violation of this law is punishable by a civil monetary penalty. Employer's Quarterly Tax Return 941. In addition to providing all employees with W-4 forms, an employer must file Form 941 Employer's Quarterly Tax Return for all income taxes withheld from employee wages. When filing Form 941 for the final quarter of a year, the employer must also transmit Forms W-2 and W-3. W-3 Form W-2 is the wage and tax statement for each employee, showing the total wages paid and amounts withheld during the year. W-3 Form W-3 is the transmittal of wage and tax statement. W-2 forms for all employees must be attached to the W-3 form, and the amount shown on the W-3 must equal the total of all the W-2 slips. Property managers should follow the latest filing guidelines published in Circular E, Employer's Tax Guide by the IRS. State obligations. To fulfill state income tax obligations, the employer must also register with the state in which the employer operates. These obligations and the specific forms used vary from state to state, but the W-2, W-3, and W-4 forms are generally used to document both state and federal income tax withholding liabilities. Non-cash compensation. When computing income for federal tax purposes, managers must indicate wages paid in any form other than money at their fair market value. Included in this category are automobiles furnished to employees and living quarters provided for on-site managers. A qualified accountant or attorney must determine the proper treatment of any item of compensation given to an employee in lieu of salary. Different treatment and amounts are applicable depending on the item and circumstances in each case. Under current regulations, the fair market value of living quarters furnished to a manager at the place of employment is not taxable to the employee if the employee is required to reside on the premises as a condition of employment. FICA insurance. The Federal Insurance Contributions Act FICA requires employers of one or more persons to pay tax into the Social Security Retirement Fund. The tax rate is set by Congress and shared by the employer and employee. The employer must withhold the proper amount from employees' paychecks and submit the total contribution from both parties to the federal government. The frequency of payment varies with the amount of the contribution. Check the latest regulations available from local Social Security offices. When computing the FICA payment due, compensation other than wages, including a free apartment, must be shown as income at fair market value. Disability and workers' compensation. In addition to Social Security, both disability insurance and workers' compensation insurance must be carried on all employees. Owners in some states obtain these through a government agency, whereas others use private insurance companies. Statement of Miscellaneous Income 1099. Employers must issue a Form 1099 Statement of Miscellaneous Income to each independent contractor vendor who is not incorporated and was paid more than $600 in 1 year, and to each property owner stipulating the amount of rent the agent collected on the owner's behalf. Unemployment Taxes FUTA. A Federal Unemployment Tax Act FUTA return must be filed by every employer of one or more persons who work for some portion of a day for 20 weeks during the year or earn at least $1,500 during the year. The total tax levied will vary according to the amount of state unemployment tax paid by the employer for each employee. A credit against FUTA payments is given for any state unemployment taxes paid. Because the laws governing state unemployment taxes vary, the property manager must pay special attention to the applicable laws in the area. Apartment operating reports. Owners of apartment buildings have the same need for operating reports as owners of commercial and industrial properties. The reports give the owner the raw data necessary to evaluate the property manager, determine the value of the investment, and decide on the best course of action. Apartment operating budgets. Apartment occupancy rates are always subject to change because of economic conditions such as employment cuts or the addition of new units to the market. Consumers have taken advantage of the low interest rates to buy their housing instead of renting. When preparing a budget, a property manager should determine if there are any predictable influences in the market for the coming budget year that might affect occupancy. For example, long periods of low vacancy rates in a community often stimulate the construction of new apartments. So in these periods of high occupancy, it is important to know what new projects are under construction and when they will be available for leasing. Additional income. In addition to the rents, rental of movies, parking and storage fees, and vending and laundry machines can provide revenue. Laundry leasing companies will install washers and dryers on a percentage basis, the rate depending on the bargaining power of the manager and the overall expected revenue from the machines. An alternative is for the manager to buy laundry machines outright on behalf of the owner. Cash flow analysis. Cash flow projections really deal only with previously used data. The after-tax cash flow analysis allows the owner to analyze actual return on investment after taxes and decide whether it is economically more advantageous to keep the property, invest more money in it, refinance it, or sell it. Also, the owner may use the manager's operating reports, particularly the cash flow, as a report card or measure of the manager's performance by comparing ratios from period to period. Following is an example for calculating cash flow using a method employed by professional accountants. An older apartment building has a reliable gross income of $100,000 per year. Its operating cost rate is 50%, including capital expenditures and reserves. At the beginning of the year, its depreciable tax base was $400,000. $5,000 was spent for capital improvements. Straight-line depreciation is computed based on an economic life of 27.5 years. For simplicity of illustration, assume that the owner is in a 28% income tax bracket and that the entire amount of capital expenditures is depreciable for 1 full year. Reducing costs. It is unwise to increase present cash flow by deferring expenditures for real maintenance needs. Savings may sometimes be made through volume buying or through an energy conservation program. Generally, an energy conservation program in apartment property cannot be carried out successfully without the cooperation of the building staff and tenants. However, the possibility for savings can be promising by installing automatic or computerized controls in many older apartment projects, particularly in the southern states. Some common sense precautions can be exercised to hold a ceiling on rising operating costs. All utility firms have energy consultants with whom the manager can confer. Utility rate schedules can be quite confusing to the uninitiated. Electric rates, for example, vary according to amount of power used, time of day, peak consumed at any one time, use to which the electricity is put, and cost of the fuel used to generate the electricity. A utility representative can determine the optimal type of service for the property and suggest ways of reducing waste. Key policy. Simple cost saving suggestions. Installing timers, preferably photocell switches if possible for hallway and outdoor lights. Installing compact fluorescent lighting fixtures. Installing storm windows. Caulking around doorways and windows. Adding insulation to protect against heat loss through transference. Installing automatic heating controls. Reducing heating hours. Key point review. Whether located on site or at another location, the office area and its furnishings must accommodate the basic functions of property management and create a good impression of the organization. There should be enough space for the firm's records and accounting system and for the reception of tradespeople and tenants. Specialized property management software is readily available to perform financial analysis, planning, electronic filing, graphic design, word processing, and many specific business applications. A purchasing agent controls all purchases made by or through the management organization. The accounting department interprets the income and expense reports on properties, initiates new procedures, and provides the owner with profit and loss statements. The bookkeeping staff receives rents, handles credit and collections, and records accounts payable. Clerical personnel may be secretarial or service request clerks. If the workers at a building are termed employees under the law, the owner must obtain an employer identification number EIN from the IRS. All employees must have a social security number and fill out a Form W-4 employees withholding allowance certificate. The property manager informs the owner of the property's financial status through the monthly cash flow reports and annual profit and loss statement. Funds should be conservatively budgeted in all four categories of expense: taxes, insurance, maintenance, and administration. It is impossible to establish a uniform system of financial reporting that meets the needs of every type of retail property. However, the owner generally wants two types of information about the property: its current financial status and predictions of events likely to influence future profits. Case study. The office manager. Don Emerson has been assigned the task of bringing professional management company property management office up to date. He has worked for professional management for 6 months now as office manager and is well aware of the need to implement new office management systems. The filing system is disorganized, everything is done manually, and the clerical staff is overworked but unproductive. However, Emerson's boss is reluctant to spend a lot of money on a new computer system. She believes that computers are overrated, they end up generating more paperwork rather than less.
Hello, everyone. We're just about done. I love these ending case studies. And we just want to kind of break down this case study. So this is a classic case of like a maybe somebody who's newer in property management, maybe well trained. They come in, and then the people who have always done it that way for years and years and years say, "Well, we don't need that. We don't want that. We've always done it this way." And Emerson should keep in mind as he sets up a new filing system, he should get a computer, right? Should Emerson try to convince his boss that a computer system is required? Absolutely, absolutely. Particularly, they have really good software called like Yardi, AppFolio. Those are kind of like the really big industry standards, and especially with a large housing units, you need the software to be effective. Assuming Emerson's boss agrees to computerize the office, what kind of system should Emerson get? Nothing too crazy. A basic computer will work as long as that he can run like AppFolio or Yardi. Those are kind of like the bigger ones that we talk about in this industry. So long as the computer can support those applications running, that's going to be the majority of what's needed. All right, on to the next unit. Good work. Keep going.